Welcome in, everyone. You are anchored right here at NovaStream, and we are streaming 24/7.
That's right, 24/7.
Whether you're watching our live crypto markets, tracking those real-time spark lines for BTC, ETH, and SLL, or, maybe you're following the global financial indices covering the S&P 500, NASDAQ Q, Forex, and commodities.
Got to keep an eye on that USD pair, too.
Oh, for sure. And, we keep the breaking news feed flowing the second those headlines hit, but right now we're taking a little step back from the minute-by-minute ticker tape.
Yeah, putting aside the raw numbers for a bit.
Right. We are jumping into our highlights of the day. So hello to you, the listener, and thanks for being here. Imagine hiring someone to build a state-of-the-art billion-dollar luxury cruise ship.
Okay, I'm picturing it.
You hand over the cash, you pop the champagne, you book your tickets, only to realize there is absolutely zero steel left on Earth to actually build the hull.
Which is a slight problem.
Just a bit. But that terrifying disconnect between what we are buying and what can actually be built, that is precisely what is happening across the global markets right now.
And that is really the mission for today's highlights. We need to synthesize a profoundly bizarre market environment.
It really is bizarre.
I mean, we are looking at a massive structural collision. On one hand, you have astronomical, boundless technology euphoria. Just pure, unfiltered FOMO.
The fear of missing out is so real right now.
It is. And it is slamming headfirst into the brutal, unforgiving bottlenecks of the physical world.
We're taking a look at a stack of incredibly diverse sources today. Everything from Wall Street analyst reports on aerospace valuations to short seller dossiers on French server manufacturers.
Don't forget the maritime logistics warnings out of the Middle East.
Right, that too. And the through line here is undeniable. The infinite promise of the digital future is completely detached from the finite realities of physical physics.
Let's start by mapping out the scale of that digital euphoria, because the top-line driver of market sentiment right now is massive speculation.
Speculation that has completely severed ties with traditional metric.
Exactly. Or, well, Scott on. Take SpaceX's historic NASDAQ debut. The stock debuted at $135 a share.
Which gives them a market capitalization of $1.77 trillion.
Trillion, with a T.
That is a very big T.
Right. But here's the mechanism I want to unpack for you, the listener. If you are a traditional investor, the first thing you look for is a PE ratio, a price-to-earnings ratio.
Standard practice.
It tells you how much you are paying for every dollar of profit the company makes, but you can't use a PE ratio for SpaceX because they aren't turning a profit right now.
Nope. So the market uses a price-to-sales ratio instead.
And it is sitting at an astonishing 95 to 100 times sales.
Which is just, to really understand how staggering that is, think about the math here.
Walk us through it. A price-to-sales ratio of 100 essentially means that even if the company had zero expenses, like if they took every single dollar of revenue and handed it straight to you as a dividend, it would take you an entire century just to break even on your investment.
100 years.
100 years. And that is what the market is eagerly paying for.
Meanwhile, Morningstar analysts came out and ran the actual numbers on their assets. They looked at the launch vehicles, the Starlink network, the AI capabilities.
And what did they find?
They estimated the company's true intrinsic value is around $780 billion.
Wow. Which leaves a gap of what, roughly $1 trillion?
Yep. $1 trillion between what the company is theoretically worth on paper and what investors are actively paying for it on the open market.
It's pure dream FOMO.
So where does $1 trillion of air come from? I look at that gap and I see people buying a ticket for a cruise on a ship that doesn't exist yet.
That's a great way to put it.
They aren't buying the present, they are buying the desperate hope of the future. Why are institutions doing this?
Well, that $1 trillion gap is fueled almost entirely by institutional desperation. The psychology here is critical.
How so?
Massive funds and retail investors are looking at SpaceX's artificial intelligence assets and the Starlink satellite network, and they are terrified.
Terrified of missing the boat.
Right. They are terrified of missing the next generational leap in growth. Reliable, organic growth is incredibly scarce in the broader market right now.
So they just price in perfection.
Yes. Institutions are essentially pricing in a full decade of absolutely flawless execution.
Yeah.
They're assuming no rockets explode, no competitors emerge, and no regulations stifle them for 10 straight years.
It feels like an environment where just hinting at future technology acts like a magic spell on your stock price.
Oh, absolutely.
Look at Rumble.
Yeah.
The video platform just announced a massive pivot. They're buying a cloud and AI infrastructure provider called Northern Data.
Right, which gets them access to what, 22,000 NVIDIA chips?
Yeah, a massive hoard of chips. And they are renaming the entire parent company to Rum Group. They're splitting their operations into an AI infrastructure unit and a video unit.
Classic pivot.
Now, I have to ask, wait, they just bought a bunch of servers and changed their name to sound more like an AI holding company?
That's basically it.
We saw this play out in 1999. Are we just watching the dot-com bubble again? You know, where a company slaps some new letters on their letterhead and capital magically flows their way?
Well, Rumble's CEO insists this is a fundamental long-term strategic shift, not a fad.
Of course they do.
But your instinct is spot on regarding the broader environment. Every corporate board knows that if you attach the letters AI to your strategy, Wall Street stops asking about profit margins.
And starts throwing capital at you.
Precisely. However, Rumble's pivot perfectly illustrates the collision we're talking about today. You can change your name to Rum Group. You can talk about AI all you want.
But you still need the hardware.
You need an unfathomable amount of physical hardware.
Because you can't run a large language model on hopes and press releases. You need silicon.
And that transition from the digital dream to the physical reality is where this whole narrative hits a brick wall. The supply chain simply cannot handle the dream.
We are seeing that failure point most acutely in the memory sector, right? Micron Technology, along with companies like SanDisk and Western Digital.
So they're experiencing massive stock rallies right now.
And the catalyst is a structural physical shortage of high bandwidth memory, specifically a generation called HBM3E.
Yeah, HBM3E.
So why HBM3E? Why are hyperscalers, the massive cloud providers like Meta, Google, and Microsoft, completely buying out Micron's entire manufacturing capacity for this specific chip?
All the way through the end of 2026.
Right. It's completely sold out for 2 years. Why that chip?
It comes down to power consumption. When you are running AI data centers that take up the square footage of multiple football fields, you aren't just limited by how fast your processors can think.
What else limits you?
You are limited by how much electricity you can physically pull from the local grid before you melt the cables.
Oh, wow.
How much heat you have to vent. HBM3E consumes significantly less power than competing memory types.
So power efficiency isn't just a nice cost-saving measure.
Not at all. It is the fundamental limiting factor of the entire AI operation.
If the graphics processing units, the GPUs, are the engines of the AI race, this memory is the fuel line.
That's a great analogy.
And the fuel lines are backordered until 2027. I mean, if the basic building materials for this tech boom are sold out, pricing leverage shifts entirely to the suppliers.
It really does. It stops being a competition of who has the smartest software and becomes a brutal fight over who can actually get their hands on the physical material.
Like, if lumber is entirely sold out, it doesn't matter how great your blueprint is, you can't build the house.
Right. And that brutal fight has very real collateral damage. The downstream effects are already hitting the consumer.
Yeah, let's talk about Apple. Tim Cook, the CEO, acknowledged in a recent interview that the surging memory and storage costs are forcing their hand.
Which nobody wants to hear.
No. He stated that hardware price hikes for everyday consumers are now unavoidable.
Unavoidable. That's a strong word for Apple.
So your next iPad, your next MacBook, your teenager's next iPhone, they're all going to cost more, simply because Meta and Google bought up all the internal parts to build AI chatbots.
Yep. The world's most valuable consumer electronics company can no longer shield its customers from the physical reality of this corporate AI panic.
Which triggers an intense geopolitical response.
It certainly does. The market is waking up to the fact that relying on fragile overseas supply chains for these critical components is a massive vulnerability.
Which explains why we saw Intel shares jump nearly 10% in pre-market trading.
Yeah, that was a huge move.
And the trigger for that jump was a post by Donald Trump on Truth Social. He stated that Apple has agreed to use Intel to design and build chips right here in the U.S.
Now, just to be clear, we are simply reporting on the news moving the markets here, not taking any political stances.
Of course. And just tracking the facts, neither Apple nor Intel has officially confirmed that arrangement yet.
But regardless of official confirmation, the market reaction itself is the story. It reveals how desperate the push is to localize this hardware.
Because it's not just about cost anymore.
No, it mirrors similar preliminary agreements we saw reported back in May and high-profile domestic manufacturing wins involving NVIDIA and Elon Musk's Terafab.
The pressure to build these chips domestically isn't just economic, it's a matter of national security and corporate survival.
Exactly.
But when you have extreme hardware shortages and insatiable demand from investors and billions upon billions of dollars on the line, The pressure to show success becomes immense.
It really does.
And when companies can't actually secure the hardware, sometimes they just, well, invent the success.
Which takes us to the bizarre and sudden collapse of a French technology group called 2CRS.
Yeah, this is wild. This is the dark side of the hardware hustle. 2CRSI manufactures data center servers.
So if you were selling the picks and shovels during an AI gold rush, you should be thriving.
You'd think so. Yet their stock just suffered a catastrophic 43% crash on the Paris exchange.
It was a total bloodbath.
Their market capitalization was well over €1 billion. In a matter of hours, it plunged below 600 million.
It got so volatile that trading was completely suspended on Euronext Paris.
Suspended entirely. And the panic was contagious, right?
Yeah.
It triggered sell-offs in completely unrelated European tech stocks just out of pure fear.
Oh yeah, market contagion is a real thing.
Yeah.
The catalyst for the crash was an exhaustive report released by an activist short seller named Grizzly Research.
And what did they find?
They accused 2CRSI of operating a fraudulent structure in the United States.
Specifically, they alleged the company entirely fabricated its revenue from a major 2024 contract.
They basically accused them of drawing the picks and shovels on a piece of paper and claiming they sold them.
Unbelievable. And the fallout was immediate. The CEO, Alain Wilmeth, was scheduled to speak at a major French tech conference on the very day of the crash.
And let me guess, he didn't show up.
He went completely MIA, vanished from the schedule. Company representatives refused to comment, and the local phone lines listed on their own official website suddenly went dead.
Just disconnected.
Yeah.
It's crazy.
Which brings up a critical point about how short sellers actually operate. Many people think short sellers just bet against a stock and post rumors online to stir up trouble.
Like internet trolls.
Right. But firms like Grizzly Research operate more like forensic accountants.
How so?
They spend months digging through local corporate registries, they cross-reference shipping manifests, and they analyze tax filings to see if the physical movement of goods matches the revenue claimed on the balance sheet.
So they are looking for physical proof of digital claims.
Yes.
I look at a story like 2CRSI, where an entire billion-euro valuation just evaporates because the servers apparently didn't exist, and I have to wonder about the retail investor. It's scary for the average person.
How on earth are you and I supposed to spot a fraudulent structure when the FOMO from Wall Street is this deafening?
Honestly, it is incredibly difficult. When an entire sector is running white hot, the assumption of success masks an enormous amount of underlying rot.
Because everyone just wants to believe the fairy tale.
Exactly. For anyone listening, the collapse of 2CRS is a stark reminder you cannot just buy the narrative. When a company is operating in a hyped sector, the burden of proof is actually higher. You have to verify the physical revenue.
And that illusion of infinite digital growth doesn't just crash when a company fakes its server sales.
No, it crashes when the actual physical energy required to power those servers and power the broader global economy stops moving.
We've talked about the micro bottlenecks of memory chips. Let's look at the macro-physical bottlenecks.
The macro-gravity of the physical world is really reasserting itself in the energy markets right now, and in monetary policy.
Let's start with the Strait of Hormuz. The U.S. and Iran just agreed to a framework for a peace deal, effectively extending their ceasefire for another 60 days.
Which sounds like great news.
Right, if you just read the headlines, you'd think global oil markets would instantly cheer, supply chains would open up, and prices would plummet.
But maritime analysts at Kepler came out with a very sobering warning.
What did they say?
They stated plainly, reopening is not a recovery.
Because the physical mechanics of global shipping don't care about a signed piece of paper.
No, they don't. Right now, there are roughly 119 laden supertankers trapped inside the Persian Gulf.
119 massive ships.
Yes. You cannot just flip a switch and have 119 massive vessels sail out at once. The Strait of Hormuz is a narrow, complex waterway.
So there's a literal traffic jam.
A massive one. Kepler estimates it will take 10 to 15 days just to flush out the physical backlog of these trapped ships before we even see a meaningful spike in regular transits.
It is the ultimate logistical nightmare, and the precarious nature of that supply chain is visible right at the local gas pump.
Oh, absolutely.
U.S. national gas prices just barely fell below the $4 mark, hitting an average of $3.999 per gallon.
Literally the smallest possible margin of relief.
Just a fraction of a penny. And that is just a national average. If you are driving in Indiana today, you might see averages around 3.4 year.
But if you are in California,
you are still staring at 5.64 a gallon.
Ouch. And it is crucial to remember the pre-war context here. Despite this microscopic drop below $4, current averages are still 34% higher than they were prior to the U.S.-Iran conflict.
So the physical friction in the energy market is still incredibly high.
Yes, and that physical friction is ripping straight into the currency markets.
Let's look at the Canadian dollar, the loonie. It just plunged to a 7-month low, trading at 1.4075 per US dollar.
Which is about 71.05 US cents.
Right. And Canada's economy is deeply intertwined with its primary exports, and crude oil is right at the top.
So when oil takes a massive 10% hit, it drags the Canadian dollar down with it.
But there is a second force at play here, which is a massive divergence in central bank policies.
Let's break that down, because this is where the monetary friction meets the physical friction.
The Bank of Canada is taking a very dovish tone right now.
Dovish meaning they want to loosen up, keep borrowing cheap to stimulate their economy because they are worried about growth.
Right. They are holding their rates steady at 2.25%, but the U.S. Federal Reserve, they are shifting hawkish.
Hawkish meaning they want to tighten up, make borrowing more expensive to fight inflation.
9 Fed officials are actively anticipating at least one rate hike by the end of the year, forecasting a federal funds rate of 3.8%.
And sitting right at the center of this tension is Fed Chair Kevin Warsh,
who is introducing a genuinely shocking new communication strategy for the central bank.
It really caught people off guard.
Warsh voted to hold rates steady at his first Federal Open Market Committee meeting. But it wasn't the vote that shocked Wall Street. It was his press conference.
What did he say?
He explicitly stated he wants to completely refrain from providing forward guidance.
Wow.
He doesn't want to give the market explicit forecasts about what the Fed will do next month or next quarter.
He says he wants to rely purely on raw economic data and let market signals guide monetary policy.
To understand why this is causing panic, you have to understand the purpose of forward guidance. Historically, the Fed acts as the adult in the room.
Right. By telling the market exactly what they plan to do, they remove uncertainty.
Warsh is essentially taking away the market safety blanket. He wants the investors to analyze the raw data themselves.
It's like Warsh basically wants to stop driving the car and let the market take the steering wheel based on the data they see out the window.
Exactly. But Morgan Stanley's fixed income strategists are screaming from the back seat that the market is currently blindfolded.
That's a huge warning flag.
Morgan Stanley is warning that the market has already priced in a rate hike, but they argue that inflation is naturally normalizing on its own.
So if Warsh hikes rates anyway?
If he blindly follows the market signals and hikes rates, Morgan Stanley says he will over-tighten the economy, choke off borrowing, and heavily damage growth.
Morgan Stanley is highlighting a very specific danger regarding term premiums here.
What's a term premium?
A term premium is the extra yield, the extra payout, an investor demands for the risk of locking their money away in a long-term bond when the future is uncertain.
So more uncertainty means a higher premium.
Yes. If the Fed refuses to tell anyone what their plan is, the future becomes highly uncertain. Without clear forward guidance from the Fed, term premiums are going to swing wildly.
Creating massive volatility.
Right. Massive volatility in bond yields that ripple through mortgages, corporate loans, and the entire economy.
So let's zoom out for a second and look at the whole board here. We have tech euphoria pricing in a full decade of absolute perfection for unprofitable space companies. We have a literal physical shortage of memory chips driving up the cost of everyday consumer electronics. We have European server companies whose billion-dollar valuations are vaporizing over allegations of completely fake revenue.
It's a lot to process.
We have 119 massive oil tankers stuck in a 15-day traffic jam holding energy markets hostage. And we have a Federal Reserve chair who wants to drop the steering wheel and let a blindfolded market figure out interest rates on its own.
It is a profound amount of chaos.
It really is. So how does an everyday listener, anchored to our NovaStream feed today, protect their life savings in this environment?
Without feeling like they're just putting their retirement on black at the roulette table.
Yeah, exactly.
That is the most vital question we can address today. And to answer it, we have to look past the noise and examine the academic theory of the lucky flipper.
The lucky flipper.
Yes, famously embodied by a man named Benjamin Graham.
Benjamin Graham is widely considered the godfather of value investing. He was Warren Buffett's mentor, right?
He was. And yet, toward the end of his life, Graham looked back at his incredible track record and admitted something startling.
What did he admit?
He admitted that the vast majority of his immense wealth was largely boosted by a single, incredibly lucky stock pick.
Which was?
GEICO.
Wait, If the godfather of value investing, the guy who literally wrote the textbook that Warren Buffett uses, admits that his fortune was mostly just a lucky coin flip,
It makes you wonder.
what hope do we have? I mean, why am I bothering to analyze PE ratios and logistics? Why not just take my portfolio to Vegas?
Because there's a crucial difference between relying on luck and managing variance. The lucky flipper theory illustrates the powerful illusion of investing knowledge.
Break that down for me.
Extensive academic studies on mutual fund performance consistently show that the vast majority of outperformance by active managers boils down to random chance.
Just luck.
Yes. If you put 1,000 monkeys in a room flipping coins, one of them is going to flip heads 10 times in a row.
And Wall Street calls that monkey a genius.
Exactly, and then charges a 2% management fee to follow his next flip. But Graham and Buffett's circle understood this. They didn't build strategies to predict the coin flip. They built strategies to survive the variance.
Okay, let's break down those survival strategies. How do you, listening right now, actually defeat the coin flip? The sources point to avoiding multi-step directional bets.
Which is so important in this current market.
What does that mean in the context of the chaos we just talked about?
Think of it like setting up dominoes. A multi-step directional bet requires a sequence of independent events to go perfectly right for you to make money.
Give me an example.
Let's say you invest based on a thesis that the Fed will cut rates, ADD SpaceX will launch its next rocket perfectly, AD inflation will drop to exactly 2%.
Three big ifs.
Right. Mathematically, if each of those events has a 50% chance of happening, your chance of all three happening together is only 12.5%. Your probability of success shrinks drastically with every new variable.
So, do not make high-stakes bets that require a fragile chain of dominoes to fall perfectly.
Keep it simple. That makes a lot of sense. The more complex the narrative, the more likely it breaks. The second strategy the sources highlight is relying on broad diversification.
Because we know individual stock picking involves an enormous amount of random chance and unseen variables.
Like a short seller suddenly revealing fake revenues at 2CRSI.
Exactly. The most robust defense against that kind of surprise is capturing the growth of the entire system. Low-cost, broad-market index funds reliably outperform the vast majority of active managers simply because they eliminate the risk of picking the wrong individual stock.
And the third strategy is Benjamin Graham's cornerstone concept, the margin of safety. I want to clearly explain how this works using our SpaceX example from earlier.
A margin of safety means you only buy an asset when its market price is significantly lower than its conservatively calculated intrinsic value.
So getting a real discount.
Yes. With SpaceX, the market is pricing it at $1.77 trillion. But the calculated intrinsic value of its actual assets and cash flows is only $780 billion.
So buying SpaceX right now offers zero margin of safety. None. You are paying a premium for absolute perfection. If one single thing goes wrong over the next 10 years, the valuation collapses. A margin of safety ensures that even if you calculate the future wrong, you bought it cheap enough that you don't lose your shirt.
And for you listening right now, taking the time to learn these strategies isn't just theory. There are highly actionable steps you can take today to protect yourself.
Very true.
If you currently have a financial advisor, don't just assume they have your best interests at heart. Go online and use the FNR Ray Broker Check tool. Verify their legal standing.
And you specifically want to verify if they are bound by a fiduciary duty.
What does that mean legally?
A fiduciary is legally mandated to put your financial interests ahead of their own profit. It's a massive distinction.
If you are looking for new advice, seek out fee-only certified financial planners. The sources recommend organizations like the Garrett Planning Network or the XY Planning Network.
You want an advisor who gets paid a flat fee to build a strategy based on risk management.
Completely insulated from the incentive to sell you specific mutual funds or insurance products on commission.
True financial security doesn't come from guessing the future. It comes from disciplined risk management.
It's about surviving the physical bottlenecks and the digital euphoria without letting them dictate your financial future.
Well said.
We've covered incredible ground today. We've gone from the $1.77 trillion stratosphere of SpaceX's valuation through the power-hungry logic of HBM3E memory chips.
Down to the forensic accounting of fraudulent French servers.
And finally, to the physical gridlock of 119 steel tankers sitting in the Strait of Hormuz. But before we sign off, I want to leave you with one final thought to mull over as you watch the tickers.
What's that?
We look at the world's most sophisticated technology giants, and we praise them for creating these boundless digital marvels. But in doing so, their insatiable demand is creating raw physical material shortages.
Shortages that are driving up the price of a basic iPad in your own living room.
We look at massive interconnected global financial indices, and yet those indices are currently being held hostage by a literal traffic jam of physical boats in a narrow waterway.
It exposes a massive contradiction at the heart of the modern economy.
It really does. I mean, if our highly optimized, algorithmically driven global economy relies on every single piece functioning flawlessly, from the memory chip fabrication plant to the Middle Eastern shipping lane to the corporate revenue ledger in Paris, is this system actually incredibly fragile?
That's the million-dollar question.
What happens to the global market when the next unseen link in that chain inevitably snaps?
It's the critical question we all need to keep in mind as we navigate these markets.
Thank you so much for tuning in to today's highlights of the day. Remember, you don't have to go anywhere. Keep NovaStream running right here in the background.
Yep, stick around.
We have your 2047 live crypto markets, all the global financial indices, and that breaking news feed constantly updating. We'll be right here, tracking every tick.
Goodbye, everyone. Stay curious and stay informed.